Wouldn't it be great to know how IFRS 2 share-based payments can be tested? Of course it would be, because if you know what to expect, you can get prepared. The first thing that many students actually miss is that there will be questions on shares that are paid for something else, like let's say for assets acquisition or for payment of some services. And IFRS 2 tells us that this very transaction will need to be recognized not at the fair value of your own shares that you transfer, but rather at the fair value of whatever you get. And you will need to be able to stress this difference. So let's say if you are going to buy a plot of land, then on a normal day, you would recognize it at cost, the same way as IAS 16 prescribes this. But if you are going to pay it with your own shares, then you are going to recognize it at the fair value. And then we have two types of the schemes, equity settled and cash settled. Cash settled scheme is perceived to be easier, but there is one very hard type of questions that can be tested. We're going to talk about it slightly later. With equity settled transactions, we basically have two problems. Problem number one is to learn what is going to change. So you will need to be able to distinguish between market conditions and non-market conditions. You will need to say that share price is a market condition, so the fair value of it is going to be calculated at the grant date, and the changes in the fair value, the changes in the share price won't affect the calculation after. Yes, we include it into the fair value of the option, and that is going to be the same up until the very end. As for non-market conditions, you will need to explain if, let's say, there is a condition that employees will get different number of share options based on them reaching certain profit target, which is non-market, then this is going to be taken into the calculation of the scheme at each and every reporting period. The next type of question that you are going to meet is modification of equity settled schemes. So the scheme was, let's say, for 5 years, and in 2 years, the company decided to revise it, making it easier or harder for employees to get those very shares. And in this very case, you will need to basically calculate 2 share options. I would remind you that you are going to continue to recognize the old one, and you are going to also recognize the modification, which is going to be the difference between whatever you had and the modification date and the new promise. And that is going to be recognized based on the remaining period. And that is basically how equity settled schemes can be tested. Cash settled schemes, on one hand, are much easier because there we don't have market non-market conditions. It's a liability, so we are going to take each and every part of the calculation. We're going to revise it at each and every reporting date. So on one hand, it's easier. And there will be no modifications because, there could be modifications, but they don't impact our calculation. We're going to revise each and every item anyways. But what you should be aware of is that the examiner may ask you to calculate the P&L effect of the payments of the share option scheme after the vesting period is reached. So what can happen is that, let's say, employees can come to the company and ask to be paid, and it can happen within the period from, let's say, 1st of January 2025 up until 31st of December 2026. And as such, you will need to calculate the P&L effect. You will need to take the fair value of the option. You're going to calculate the scheme based on the options employees remaining at the start of the period. At the end of the period, you are going to deduct the cash that was actually paid. And the balancing figure is going to be P&L, which can be gain or which can be loss. So make sure that you haven't skipped this part of the question. And finally, when we're talking about question number 2, when we're talking about the perception of the financial statements, what can happen is that an accountant would mistakenly record this scheme as part of equity and not as part of a liability. So even if it is a cash settled scheme. And in this very case, you would need to explain that gearing looks better than it actually is. So the company is perceived to be less risky by stakeholders. And you would need to talk about the ethics, right? So that part of the standard can be tested as part of your question 2. And of course, there are other provisions in the standard, but whatever we have discussed has the highest chance of being tested, so make sure that you understand how to account for each of these scenarios.